Log into any brokerage account today, and you are instantly hit with thousands of tickers, flashing charts, and endless streams of financial ratios. The volume of raw data is designed to be overwhelming. When faced with that kind of chaos, the natural instinct is to look for a shortcut. We try to find a single metric, like the stock with the absolute highest profit growth, and base an entire investment strategy on it. Isolating a single data point is a mistake. A company might show massive triple-digit growth on paper, but if it's built on a weak financial foundation, it operates like a house of cards, ready to collapse under economic pressure. To cut through the noise, we need a better system. We'll treat the consistent growth basket as a case study to test a disciplined, critical thinking framework. We evaluate companies using 4 distinct pillars: durability, profitability, efficiency, and margin of safety. These must interlock perfectly to form a solid investment thesis. Tracking the relationships between these metrics filters the noise, leaving only the high-conviction signals. First, we look at the relationship between a company's engine and its armor. The engine is the 3-year net profit growth. The armor is the trendline durability score, which measures balance sheet strength and low default risk. Our data table shows Privy Specialty Chemicals with an extraordinary engine. Over 3 years, they expanded net profit by 1,374%. This is significant because it's backed by armor. Privy holds a durability score of 90, indicating this massive growth is supported by financial health. We see the same pattern in CCL products. While their profit growth is a more moderate 44%, they maintain that same elite durability score of 90. A powerful profit engine is a liability if the company lacks the financial health to protect its capital. The armor ensures the business survives long enough for the growth to matter. Once growth and safety are verified, we measure how well the company uses shareholder money. This is the return on equity, or ROE. This column tracks annual ROE, where Timex Group India stands out as a clear outlier with a return on equity of 100%. A triple-digit ROE indicates a business that can generate high returns without requiring massive new capital injections. It reflects an efficient operation that has successfully leveraged its brand to drive a turnaround. High capital efficiency acts as a financial multiplier, turning profit into compounded shareholder value without requiring management to take on significant new debt. Even a company with a strong engine, high durability, and top-tier efficiency is a poor investment if the entry price is too high. This is why we use the discount to 52-week high. It is a final reality check that establishes our margin of safety. Sarda Energy and Minerals passes the first 3 pillars easily, showing 83% profit growth and a top-tier durability score of 90. However, the data shows the stock trading at an 18.6% discount from its recent high, creating a potential window for entry. Buying durable businesses during temporary pullbacks provides the necessary margin of safety. This discipline separates strategic investors from those who chase stocks at their peak. Looking at this master data table, we see the framework operating as a system. Profit growth is validated by durability, while ROE and discount ensure the investment is efficient and priced correctly. Demanding all 4 metrics simultaneously also creates natural sector diversification. Because the framework focuses on financial health rather than hot trends, it surfaced strong companies across tea, iron, and specialty chemicals, as well as logistics. This diversity lowers a portfolio's exposure to a single economic shock. Real portfolio strength comes from the harmony of these figures. When all the metrics validate each other, you no longer need to frantically hunt for individual lucky picks. Successful investing requires the discipline to demand these 4 interlocking metrics in tandem every time you evaluate a stock. Apply this framework to your own research to build high-conviction baskets. The data is available, you just have to use it to filter out the noise. This methodology is for educational purposes to help you evaluate financial tables. Always consult a SEBI-registered advisor before making actual trades. Keep learning and invest smartly.